you know how much it costs to build one AI data center, just 1 gigawatt? $80 billion. Now multiply that. Right now, 100 gigawatts of AI infrastructure projects are under construction across the planet, all at the same time. Do the math, and that is $8 trillion moving through this system right now. To pay that back, these companies need $800 billion in net profit every single year, forever. The IBM CEO ran these numbers himself in public on the record, and his own conclusion was that it is basically impossible. So where is all that debt sitting? You will not find it on any earnings call, any press release, any headline number, because most of it is not even on the books. It is sitting one layer removed in structures built specifically so you cannot see them. Here's my conclusion, right up front before anything else. This AI data center boom is not going to collapse because demand disappears. It is going to collapse because of how it was built. The debt is hidden in places most investors never look. And the collateral behind it, the GPUs themselves, are aging faster than anyone in this industry wants to admit out loud. Everyone is watching the headline CapEx numbers. Almost nobody is watching the plumbing underneath it. That is exactly where this breaks first. Why does any of this matter to you? Because if you are holding semiconductor stocks, AI infrastructure stocks, anything even touching this trade, you need to know exactly where the fault line sits before it cracks, not after. My name is Moon. I obsess over tracking where this money actually flows, who really carries the risk, and who gets left holding it when the music stops. If that sounds like something you need, subscribe. And if this helps you, hit like. Here is what almost everyone assumes. Big tech is rich, so they are just paying cash for all of this. Wrong. Oracle, Meta, XAI, and CoreWeave have already pushed $120 billion of AI infrastructure debt off their balance sheets into shell companies called SPVs, special purpose vehicles that exist for one reason, to make the debt disappear from view. So follow the money. Wall Street giants, JP Morgan, PIMCO, BlackRock, Blue Owl, pour billions of dollars into these SPVs. The SPV turns around and buys nvidia GPUs. Then it leases those same GPUs right back to the tech company that needed them in the first place. Look at Meta's Beignet deal. Meta owns just 20% of that SPV, but it guaranteed the residual value of the GPUs inside it. In plain terms, if that equipment loses value later, Meta already promised to eat the loss itself. 20% ownership, 100% of the downside. That is not an accident. That is the deal. XAI is running the same playbook. Up to $12.5 billion of its $20 billion raise is debt, funneled straight into GPU purchases that get leased right back to XAI. None of this shows up on a credit rating sheet, and that is the entire point of building it this way. Keep the balance sheet clean, keep the credit rating intact, keep borrowing costs low. But the risk never actually left the building, it just moved into a room investors are not looking at. Now watch who is already running for the exits. Oracle tried to raise $38 billion in debt, and Morgan Stanley thinks that number could balloon all the way to $75 billion. Right after that announcement, Oracle's credit default swaps spiked. That is the market quietly betting that this company could actually default. CoreWeave is worse. 4% operating margin. And it still has to cover interest on debt piled on top of that. One Wall Street analyst called it one of the most fragile balance sheets in the entire tech industry, with 50% downside built into the target price. And here is the part that should actually worry you. The banks are already trying to get out. JP Morgan and MUFG lent $38 billion for Oracle's data centers in Texas and Wisconsin. And right now, they are quietly trying to sell that debt off at a discount to anyone who will buy it. Regulators are watching the same pattern from a different angle. AI-related financing now accounts for more than a third of all growth in private credit markets. When banks that underwrote these deals start calling the deal sizes out of scale to anything they have seen before, that is not noise. That is a warning shot. But here is what almost nobody is talking about, and it is the real engine behind everything I just told you. The GPUs backing all of this debt do not last. They run 24 hours a day, non-stop, training models under constant heat and load. And every few months, a newer chip makes the last generation obsolete. Realistically, that hardware holds serious value for maybe 3 years. The debt sitting behind it is due in 5 to 10 years. Sit with that gap for a second. Run the numbers with me. On an $80 billion, 1 gigawatt data center, roughly $40 billion of that is GPUs. In 3 years, if that collateral loses half its value, $20 billion has evaporated. The debt has not moved an inch. That gap, collateral melting away while the debt just sits there unchanged, is the real detonator in this entire structure. Compare that to a normal building. A warehouse does not lose half its value in 3 years. It does not get replaced by a newer warehouse every 18 months. GPUs do. And yet the financing behind them was built using the same long horizon you would use for a building that lasts 50 years. So, what do you actually do with all of this? 3 things. First, check whether a company's debt is sitting off the balance sheet, hidden inside SPVs or joint lease structures. That is a warning sign every time. Second, check how concentrated its revenue really is. CoreWeave leans almost entirely on OpenAI, Microsoft, and Meta. And if even one of those 3 stumbles, the whole thing goes down with it. Third, watch credit default swaps and bond yields, not the stock price. They move first, every time, exactly like they did with Oracle. Catch these 3 signals early, and you are months ahead of everyone still staring at the stock chart. Right now, some of you are thinking, the stock has not crashed yet, so maybe this is overblown. Maybe this is just fear for clicks. Here is your answer. In May, Anthropic raised $65 billion and, for the first time, passed OpenAI's $852 billion valuation. Days later, Oracle hit a 52-week low. CoreWeave dropped 35% in a single trading session. These companies are financing each other, buying compute from each other, and propping up each other's valuations in a closed loop. And the market keeps marking that loop down, then quietly unmarking it over and over. That flinch right there is the signal everyone keeps ignoring. Think about what that actually means. If the companies propping up the entire AI trade are, in large part, propping up each other, then the moment one of them needs real outside cash instead of another round of mutual promises, the whole loop gets tested at once. That is not a hypothetical. That is already happening in real time, in the numbers you just heard. And once one piece of a circular financing loop breaks, it does not stay isolated. It pulls on every other name connected to it because they were never actually independent companies to begin with. They were one interconnected bet, wearing different names. So here is where I land. AI data centers themselves are not going anywhere. The technology is real, the demand is real. But a meaningful share of the companies built on this exact debt structure will not survive what is coming. Remember that $80 billion number I opened with? Every dollar of it runs through exactly the machinery I just walked you through. Hidden debt, aging collateral, and a handful of companies betting on each other to hold the whole thing up. From here on, track where the money actually goes and track who really owns the risk when it breaks. That is how you get through this. Not by panicking and not by assuming everything is fine just because the chart has not broken yet. The companies that survive this will be the ones with real revenue, real customers, and debt they actually own on their own books. The ones that do not will not get a warning label. You have to build one yourself, starting with the 3 signals I just gave you. Protect and grow what you've built.